Hello, everybody. Welcome to this webinar brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia and managed by our company Wellford. So today we are very excited to bring to you this topic, which is start of a new cycle. So how is everybody doing on this 27th of April? Hope you all are doing fine. And thank you so much for tuning in so early for this webinar. And as we know that the domestic economy is recovering, so setting the stage for very strong, possibly strong corporate earnings ahead in 2021. So what risks will lie ahead? Will the path forward is going to be smooth? So today we are going to delve deeper into this topic as we invite the head of research from Kenanga Investment Bank, Mr. Koh Huat Sun, to share on this topic. All right. Now, disclaimer. Whatever what you share on this webinar is only for educational purpose only. In no way that we give any buy or sell signal to any stock. So if you decide to buy or sell or make any investment decisions after these sessions, you do it at your own risk. Is that okay? Now we already have a few hundred of you on the line. So without further ado, gives me a great honor to introduce our speaker today. So Mr. Koh Hua Sun is a veteran in the Malaysian capital market. So he joined Kenanga Investment Bank as the head of research after 19 years in senior management capacity in the fund management industry, where he held the position of chief investment officer. Now, prior to his fund management experience, he was an investment analyst with various sell-side research establishments, which include SG's Research, RHB Research, Ong & Co, and CLSA. Mr. Koh holds a Master of Business Administration from Melbourne University, Australia, and a Bachelor of Arts degree from Oxford University, England. As head of research, Mr. Koh is responsible for formulating market strategy through carefully considered and timely analysis of macroeconomic and equity market conditions. So, without further ado, let me just hand over the sessions to Mr. Koh. Mr. Koh, are you ready?
Yes, thank you, Shane. Thanks for the introduction.
All right, excellent.
Is my slide up on the screen?
No, you have to share your slide. Because just now I shared my slide, so your slide was stopped.
Okay, give me a second. Is it there?
Yes. Yeah, okay. Now we are seeing your slide. Perfect.
Okay, thank you very much, Shane. Thank you for the introduction. And good evening, everyone. It's really nice to be able to join in another session of Equity Outlook. I think the last time we had this was December, right? Yeah, okay. So it's nice to be here again. And I hope everyone is safe and well in these trying times. Firstly, okay, let's get on to the presentation proper, yeah? Let me scroll the slide. Okay, let me start with a review of the COVID issue, the COVID situation. I think most of us, it's fair to say that most of us are still concerned about the situation here. I think it's very easy to get disheartened by news of spikes in cases, especially of late. We've seen a lot of cases in India on a daily basis, reaching records of 300,000 being reported daily. We also hear of news that some of the vaccines being deployed have issues with side effects, and therefore some of these had to be paused or reviewed. So it's very easy to get discouraged and unsettled by these kind of developments. But I think it's very important for us not to lose sight of the fact that these vaccines do work. Because if you look at the underlying trend in the number of cases, right, in countries where the vaccines were first deployed and being administered at a faster pace, for example, in the US and the UK, the trend is quite encouraging because we're seeing a fall in the number of cases from the peak in the winter peaks. For example, in the US, the recent winter peak was about 250,000 per day. And the latest numbers that we're reading is less than 60,000 now. In the UK, during the winter peak, we read as much as 60,000 cases being reported a day. And that's now down to less than 5,000. So it's encouraging because these countries where vaccines are being deployed at the fastest pace and deployed early, we're seeing the results already. I think in the case of India, maybe there's the question of issues with administering the vaccines, and also probably the SOPs not being handled in the way it should be. And so it's more like an isolated case in my mind. I think it's the difference between what's happening this year and last year is that last year at this time we were at the start of a global pandemic where there's very big concerns that this pandemic is going to spread globally, and governments were really at a loss as to what to do. Whereas now, we are at the advanced stage of handling this crisis. Vaccines does help, as I've explained, and cases like what's happening in India and even in Malaysia, we're seeing recently spikes in cases, are probably something quite isolated in my mind, and will eventually be dealt with in a very positive way. And I think the other thing that we need to note about the vaccine is that although being vaccinated does not protect the vaccinated from being infected, but in the event of the vaccinated being infected, it is highly likely that the infection will not be a deadly one. So I think this is also a very, very important thing to bear in mind. What I'm trying to say here is that as vaccinations become more widespread, more and more of the global population will be protected from very severe cases. And therefore, that is actually a big plus in dealing with this crisis. And I guess, how will it all end? I think it will all end with, in a whimper, if you like, because I think, COVID will be here with us for a while longer. But the difference, I think, going forward is that people will be better protected. So I think it's something we're going to be able to deal with going forward. And as investors, I think we should really look upon this as diminishing risk rather than, certainly compared to last year, this risk is a lot less today than it was a year ago. So I think going forward, there is hope that, the economy can gain traction on the way forward. And which brings me to the next slide here on the economy in Malaysia. For this year, we are looking at a economic recovery of 6.5%. Let me get, 6.5% GDP growth, which is a sharp turnaround from last year's contraction of -5.6%. And that will be driven by recovery in almost every pillar of the economy, the biggest of which will be private consumption. Private consumption shrank about 4% last year. We see nearly 7% growth this year on account of the easing of lockdowns, hopefully, as the year progresses. Economic reopening, people being able to travel more, especially in terms of domestic tourism. We hope to see that normalizing probably in the second half of this year. And also in terms of investment, we are looking at a recovery from around about -14% last year to about 8% this year. Much of that also is being put in place by public investments. If you recall, budget 2021 was quite a generous one in the sense that there was quite a lot being allocated for development expenditure. In fact, the number was a record high, 69 billion to be spent in 2021 compared to 50 billion the year before. So that will be put to work this year. And lastly, not forgetting that the external demand or net exports is going to be also a major driver of growth this year. We see net exports turn from -12 to nearly 4% this year. Don't forget that our major trading partners, right, namely the US, actually China is now our biggest trading partner, and the US being the second one. China is growing at a very rapid pace. Nomura has projected China to grow 8.5% this year. In the first quarter, it was up enormous 18% year on year. So that's amazing. And for US, the Fed is looking at 6.5% growth, consensus 5.5%. So that's amazing for an economy that is advanced and large as the US. So with these two large trading partners really revving up, right, I think you could safely assume that, you know, the exports to these destinations will also, you know, go up quite a bit. Okay. Right. I think it's also pertinent to say that I think the one reason why the economy has been able to, you know, stabilize, you know, and also be able to weather the kind of storm of last year is in no small measure due to the government putting in all these stimulus programs to set a floor under this, you know, very weak economy. Just to review what happened in 2020, the government put in a total of 305 billion stimulus package, of which 55 billion was actually direct funding from the government, which is nearly 4% of GDP. And these stimulus are in the form of the big part is actually the loan moratorium given by the banks. That's very important because it helped the, you know, the borrowers, especially not just the men in the street, but also the SMEs and corporates, to be able to manage their cash flows and meet their debt of financing obligations in a sort of an orderly way in the face of all these cash flows issues. So that helped to put a floor under, you know, the weakness in the economy. I think for the man in the street, we've got Bantuan Prihatin Nasional, which is actually the just cash handouts, aid for the people. Micro SMEs were helped by loans and also grants. Wage subsidy was very important to keep the jobs in place, and so forth. So these were actually in no small measure helped to set a base for the economy from which to rebound. And for this year, we've got another additional 20 billion from the Permakasa. So these stimulus packages were actually very helpful. Also helpful to helping the economy recover was the fact that EPF came in to offer some sort of you know, withdrawal facilities in the form of I-Lestari and I-Sinar. I-Sinar was actually very well used. I mean, the latest number we got from press reports suggests that a total of 53 billion has been set aside for withdrawals this year, and this is on top of 22 billion that's been withdrawn from account 2 under I-Lestari. So the long and short of this is that EPF, for the first time, is going to face a cash flow deficit this year to the tune of about nearly 40 billion. So, but that's necessary for, you know, the people to be able to sustain themselves financially in the face of these difficulties. And so, as I say, all these measures help, you know, the people and also corporates to survive this difficult period, such that going forward, we expect growth to come back 6.5%. And if you want to be granular about it, right, see how the GDP growth is going to progress by the quarter. We're seeing first quarter results to be out probably in a few weeks' time. We expect first quarter of 21 to be impacted by MCO 2.0, as we all know, which was imposed on the 13th of January. And that will cause a sequential decline in GDP from the fourth quarter of last year, as well as year on year. So we are not really out of the woods yet this quarter, and even we're not really being very optimistic about the second quarter. But where we are hopeful and optimistic is in the second half, we're going to see GDP growth pick up to the tune of about 12.2% half on half and nearly 7% year on year. So that's where we are seeing the economy grow. And in terms of GDP in ringgit, right, in constant ringgit terms, we're actually expecting 2021 to chart something like 1.43 trillion ringgit. And this matches the 1.42 trillion that was recorded in 2019 before COVID set in. So what I'm suggesting is that we are actually optimistic to the extent that, at 6.5% GDP growth, we are going to see a level of activity matching pre-COVID levels. Of course, 2020 has been, down, it's a down year of minus 5.6%, but we are seeing 6.5% growth this year. And that's going to set the base for corporate earnings to recover. So that brings me to the next subject of corporate earnings. The corporate earnings that I refer to are the earnings of the FBN KLCI, which is a barometer of our stock market. They are represented by 30 large cap stocks in this market. And this is how it looks like from year to year. In 2019, the KLCI delivered something like 95.2 cents per share equivalent, yeah. And in 2020, because of the pandemic, it fell to about 75.5. But in 2021, our forecast is for EPS to grow to 112.8 cents. And that represents a 49% rebound from the low base of 2020. And now the remarkable thing is this. At 112.8 cents, right, we are suggesting that corporate earnings will exceed pre-COVID levels of 95.2. And this is not just a dead cat bounce from a low base. That level is sustainable. We think that 2022 EPS will be about 112. So we are saying that there is some sort of momentum, something holding up the corporate earnings into next year, right? So let's see how these, what's driving these earnings growth by sectors. I have in this chart sort of a horizontal histograms of earnings by sectors. The one at the bottom here is the banking sector. They are the largest component in the index. They represent around 31% of the weight by weight. So they matter a lot. You can see that for 2021, we are looking at about 24% growth for the banking sector. The green bar here against the brown. The brown is the 2020, so green is 2021. And that momentum, the growth momentum continues into 2022. How is this achieved? We think that banks is going to grow by virtue of the fact that loans is going to pick up. Even during the recession of 2020, right? The loans growth was about 3%. So we're looking at about 5% this year. And also helping banks' earnings grow would be NIMs recovering after severe contraction last year because of OPR cuts. And also credit costs is probably going to normalize. So that momentum is going to carry through in 2022. The other sector that will contribute to 49% growth would be obviously healthcare. And here I'm talking about gloves. Remember, there are three glove components in the index, namely Top Glove, Harta Lega, and Supermax. So they're going to grow amazing. This year, ASP, I think we can see already. ASPs, we can see the pipeline of orders till the third quarter or even the fourth quarter of this year. So 100% growth is in the bank, right? We have penciled in a decline in ASP for 2022, so we're going to see a sharp fall as well in 2022. But again, the fall in 2022 due to the sector, rubber glove sector will be compensated for, offset by the continued growth in the banks, which is why we're able to hold the EPS fairly flat for 22 over 21. And this year also we're expecting gaming, namely Genting Berhad, to turn around. Genting Malaysia may still be settled in some losses, but a lot less losses than what they suffered in 2020. So turnaround in the gaming sector also helps. And building material would be press metal. I think press metal is enjoying a good ride in the sense that aluminum prices are skyrocketing. I think they're above 2004 at the moment. So, you know, they're going to be a beneficiary of ASP as well. So where does that leave us in terms of target for the KLCI this year? We are looking at 1745 this year. And today, I think the market closed at around 1606 or thereabouts. So we are suggesting that there is a 10%, nearly 10% upside on the CI for this year. And how is this arrived at? We arrived at this by applying a forward price to earnings multiple of 15.6 times on next year's EPS of 112, right? Round up 112. So that gives us 1745. And 15.6 times is a multiple which we think is robust, defensible, in the sense that, without going into too much academic here, I just want to tell you that 15.6 times reflects an earnings risk premium of about 3.1%, or half a standard deviation above the 10-year mean. This earnings risk premium is to reflect risks that may still be has the effect of lowering valuations. You know, obviously when the risks are high, you demand higher return, right? So that accounts for that. I mean, there are risks like in election risks. Maybe some of us might be still concerned that we're not out of the woods yet as far as COVID is concerned. You know, sensing that risks are higher than the average over the last 10 years, you know, you may want to. So we decided to put a risk premium that is above mean. So that's reflected in 15.6 times. And 15.6 times is also a premium over 10-year mean in terms of the multiple itself. The multiple over the 10-year is about 15.1, just above 15 times. And we are putting 15.6 times. The premium, the reason why we are willing to pay more than normal for the market is because, remember, interest rates are very low these days. We don't think interest rates will rise this year. The risk-free rate as measured by the CR, by the 10-year bond yields is about 3.1%. If you look at the past 10 years or so, I think it's probably averaged closer to between 4 to 5%, right? So because cost of funds is low, that justifies us putting an above mean multiple to arrive at the target price. So there you go. So our top-down approach values the market at 1745. The other way to look at target levels would be to apply target prices for each of the 30 component stocks, multiplied by the index shares as represented in the index. And here we arrive at a bottom-up target of 1813. So what we're suggesting is that, you know, the target could even rise beyond 1745. 1813 is a number that will be will be arrived at if you use a 3.1% MGS yield instead of 3.3%. So that is also something that is actually very reachable. Yeah. Okay. Enough of those numbers. Let's move on to talk about some of the positive market developments that has happened recently. Are as follows. I think these are very good stuff that's been happening, but not quite appreciated by the market. Especially, I'm talking about the stock market here. Number one would be the removal of Malaysia from the watch list by the FTSE Russell Committee. They have reinstated Malaysia unconditionally into the World Government Bond Index. Now that's highly positive for MGS market because that actually brought in interest in foreign interest back into the Malaysian bond market, and that will help in terms of that has helped because yields have been lower as a result, and that means that the government, when they go to the bond market to borrow, they'll be able to do so at a lower price, at a lower cost. So that's actually very helpful. The other thing that's positive for the market is the Celcom-Digi merger. We think that this merger is highly positive, more likely to go through this time compared to last year when they were trying to do a regional merger. This one will be a local one where they only involve Celcom, so it's a lot more straightforward, less complicated. And we see the benefits in the form of synergistic gains once the merger is consumed. And management will be able to rationalize costs, be able to compete, probably even lower prices, hopefully, in a sustainable fashion, while maintaining margins for the outfit. But I think also not forgetting that this, in terms of the impact on Axiata especially, it makes sense. Digi has traditionally been structurally trading at a higher multiple than Axiata. So by actually injecting Celcom into Digi, they're actually extracting a higher value, having Celcom embedded within a listed company that carries a higher multiple. So even if you apply say a 20% holding company discount on its holding in Digi, so because Axiata will end up holding 1/3 of Digi, the sum of parts valuation for Axiata is actually higher than if having Celcom within itself. So I think this is actually a value boosting exercise for Axiata, and for Digi shareholders, you benefit because of the eventual synergistic gains that should be realized when this merger gets underway. It may not be a one-year thing, but over time, I think we should be able to see the benefits, the synergistic benefits materializing. The other positive effect on the market that we've seen lately, rather positive news that we've read, has been the details of the MRT3 being announced by MRT Corp. It's good that some of these details have been unveiled, and the details have not disappointed. In fact, I think it's surprised slightly on the positive because, for example, in terms of the length of the MRT3, is actually of greater length compared to the initial projection of 40 kilometers. It's actually going to be 50 kilometers. And also the underground portion is going to be longer. I think you're looking at about 20% 20%, or you're talking about 40%. Sorry, I'm talking about 20 km, which is underground, which is longer than initial estimates. So there's a lot more to MRT3 than previously thought. And we expect tenders to be called sometime in August, and the awards should be out probably in the first part of next year. So it's good to see this out as well. And lastly, in a small way, I think banks Islam restructuring is actually a very good thing. But what they're going to do is basically take out takaful and distribute it up to the shareholders, so that shareholders actually hold takaful directly instead of via Bank Islam. That will remove the holding company discount, and also list Bank Islam itself rather than under holding co. So all these are actually very positive, but the market hasn't been responding as it should. Perhaps it does reflect that the kind of cautious or pessimism even that's still prevailing amongst investors at this point in time. Actually, speaking of cautiousness in the market, I think I just want to maybe share with you some observations in terms of fund flows, right? We've observed that it's the retail funds that's been putting money in the stock market so far this year. We've seen outflows, especially by the foreign investors, as well as even the local institutional investors. There have been an outflow of funds so far this year, right? So there's a lot of money in the sidelines held by these institutional investors, which is actually a good thing if you have the patience for with expectations that this money in the sidelines will be put to work later in the course of the year. Okay, let me move to the next subject of risk. I think there's one risk that we need to keep an eye on, and that is the risk of inflation. Why is inflation important? Because inflation has implications for monetary policy and for the pricing of money. I mean, basically, you're talking about interest rates. Yeah, I mean, obviously, the higher the inflation, then the tendency would be for interest rates to go up. If cost of funds go up, then therefore, your risk assets valuation will come down. So that's where the risk is. There have been a concern since the start of this year that inflation could rise too high, too rapidly, and we have seen that concern manifest itself in the form of heightened volatility in the bond market. And the source of this volatility has been from the US. So I think we've got to look at what's happening in the US in terms of inflation expectations. Okay, just a bit of background. The Fed looks at inflation in terms of core PCE, right? And at the moment, the core PCE in the US is about 1.4%, versus the kind of the 20-year mean of about 1.84%. So it's below mean at the moment. And what the Fed is guiding the market is to expect the core PCE to rise in a very rapid fashion to 2.2% by the end of this year. Now, you're talking about a swing of 80 basis points or 0.8%. So in the scheme of this chart here, we are here 1.4%. What Jerome Powell is telling us is that do expect this number, this line to go up to here, 2.2%. That's a very, very steep increase here. And in fact, that's about 2 standard deviation swing from 1.4 to 2.2. So in the scheme of historic variations, right, this is actually a very, very rapid increase. So that's the kind of that's a source of concern by the market, right? But okay, what is the market now saying? If you look at the okay, in terms of inflation as reflected by the stock market, one measure which I use is US break-even inflation rate, because it tells you the expectations by the market of forward inflation. We have here the US break-even inflation rate from 1 year to 10 year. The blue line represents where we were at the end of last year. And US break-even inflation rate has risen to this line here currently. So what the market is telling us is that it's expecting US inflation to rise by something like 80 basis points, 75 to 80 basis points, which is exactly what the Fed has been guiding, from 1.4 to 2.2, 80 basis points up. So I think we've reached a stage after a very volatile period in February and March, right? We've reached a stage when the market is now on the same page as the Fed. Yeah, there's no tension between the two views, which is good, because that means that the market is now kind of like there's a semblance of stability after a bit of volatility last couple of months. Now, the important message that we have to bear in mind is this: even with such a large swing upwards in inflation rate, the Fed is guiding that they will leave Fed funds rate or interest rates unchanged, right? Now, that's very important, because that means that your risk-free rate, or the number you use to value risk assets, is not going to change. So that's highly positive. No change, no rise in interest rates this year or even next year. And that means that interest rates will remain low, liquidity will be plentiful. And these two conditions are essential for markets to continue rising, right? So that's very, very important. But I think it's important for us, certainly for me. I'm going to be an observer of the US break-even to see whether market has now changed its mind. I suppose a relevant question for us to ask is whether this implied forward rate can go up, in the months to come. And I offer my explanation. I offer my view that it's not going to go up, and this is the reason why. One reason is because I think that the jobs market in the US is still very slack. Unemployment in US is about 6% at the moment. 4% is where full employment is. And when the jobs market shows jobless rate below 4%, that's when you start worrying as a central banker, because that's when inflation starts to become a real problem. Now, if you look at the past sort of 20 years, right, the occasions when the jobless rate fell from 6 to 4% are periods which of about, in going from 6 to 4% in the two occasions of the past, within the last 20 years, it took 3 years to see those numbers coming down from 6 to 4. For example, here you can see 03 was when, just after, this is about, 2003 to 2006. Yeah, it went up from 6 to 4%. Another occasion was here, 2014 to 2017. So another 3 years. And it was only when it fell below 4% in 2018, Jerome Powell pulled the trigger and say, I got to raise interest rates. That was when interest rates were raised. So what I'm saying is that we are now at 6%. It's not going to happen this year. It's not going to fall to 4% this year or even next year. So in a sense, we think that inflation is not going to be a major problem this year. Right. Okay. Now, given the sort of the market environment that I've described, right? How do we as investors, where do we put our money? So one of the sectors which I like in this environment would be REITs. It's not going to be an instant performer. I think REITs will take time to recover. But I think the worst of the bad news with regards to REITs are actually priced in already. Last year was a bad year for REITs because of the collapse in rental income, because of the rental rebates that mall owners were giving to tenants. This year we're seeing this rental income, the rental rebates diminishing, much less, and so you're going to see income going up because of that this year, and also earlier this year because of REITs were weak because of the fears over a steepening of the yield curve because of the inflation scare. Now that yield curve steepening is more or less stabilized. So therefore, valuations are more or less more stable at the moment. So going forward, we're saying that rental income will be restored because of the lessening of rental rebates, and also the other thing to note about REITs is that it's been a very bad laggard compared to the other sectors which were COVID victims. For example, here this chart, what I want to show you is that the sin sector, which is where the gaming and also the breweries are, they are now at these levels compared to the end of 2019 before COVID, right? So they've gone down a lot and they've recovered quite a bit. REITs have been it was less volatile, but over the last 16 months or so, they're actually below where they were. And they're still, in terms of price levels, they are roughly where they were in March last year, right? The worst performing ones will be hotels now. I think hotels will be laggard for some time to come, because it will take a while before international travel can resume. And so I think all considered, REITs would be a sector worth considering if you have a, say, 12-month investment horizon. And for REITs, right, if you look, this is how the quarterly earnings or realized net income has changed from quarter to quarter since the first quarter of 2019. The worst is, of course, 2Q last year. There was a recovery in the third quarter, but then because of the spread spiking up again, 4Q was a sequential decline. We expect first quarter results are being announced, going to be announced. Some of them has actually come out already, but in the course of this result season, we don't expect much from REITs in terms of the first quarter, but we reckon that second quarter is going to see better numbers. Yeah, and our REITs analysts project that over the next 2 years, we are going to see a steady growth in realized net income of 16% per year over the next 2 years. So yeah, that's all I have for REITs. And yes, just let me put in a word on what to expect in terms of the change in FBM KLCI's composition when FTSE rebalances the index. We are quite confident that Mr. DIY will be admitted into the KLCI in June, and it's okay. Two stocks risk being withdrawn from the index. It's either Sime Darby or Supermax. At the moment, it looks more like Supermax, but I think rubber gloves counters are recovering, so there's a chance that Supermax will remain in the index and out goes Sime Darby. And in terms of sector recommendations, these are the ones that we like. We actually, as I say, we are bullish about the market, so we don't have any underweight sectors to recommend. So the overweight ones that we like are the banks, construction, rubber gloves. We still like rubber gloves because we think there's oversold a lot of. And I think the pandemic isn't over. I think, like I say, COVID will probably be with us for a while longer in a less deadly form, and people will continue to be very vigilant in terms of personal hygiene and protection. So I think gloves will continue to be something consumed for a while longer. We like technology as well. There's a lot going on for technology. I think technology in Malaysia, we are not just a beneficiary of the US-China trade tension, where we see supply chain reorganization or restructuring that has benefited the Malaysian suppliers. but also just as much, there is actually a very strong demand for chips at the moment. And it's not a supply side issue, actually. It's actually a very strong demand for chips because we've seen, like, for example, the trend of working from home has led to a great deal more demand for endpoint devices, your laptops, your iPads, and so forth. And also, there's a strong recovery in motor sales, in China especially. It's been a few months already where they've seen positive year-on-year growth in car sales, but Europe also picking up. And also not forgetting that EV, electrical vehicles actually getting to be a bigger part of car sales. And these vehicles have high electronic contents. So, and not forgetting 5G development is going to pick up pace. We are seeing more 5G smartphones now being sold. And I think Inari, for example, will be a beneficiary of that because they make RF packaging for smartphones. MPI does RF packaging for the 5G networks. And MPI is also going to supply more and more components for the automobile market, which is actually very good. So there are a lot of a confluence of very, very good things happening that will boost demand for technology going forward. So I think I sort of end there. Maybe if you're keen to know our top 10 picks, this is the list. The REITs that we like would be Axis REIT, KLCC. Construction would be Gamuda. The banks that we like would be Maybank, RHB. The small caps that we like would be Paratransit and Tongguan. So I think with that, I've used about nearly 15 minutes of our time. So you've got any questions to ask, I'll be very happy to try and answer them.
All right, great. Thank you so much, Mr. Koh, for sharing with us your research. So if you have any question to ask Mr. Koh, please write in the Q&A box so that we will be able to address them. Of course, we usually have a lot more questions that we can cope. So please don't type your questions in the chat box because we will overlook it. Okay. For our friends here who are tuning in from YouTube, you may write your question in the live chat and then we will pick some of your questions from there. All right. So the first questions we have here from Mr. KK Chua is he would like to ask you, Mr. Koh, like with the surging CPO prices, why is plantation sector still rated neutral?
Right. Okay. That's a very good question. Well, the reason for that is because we think that CPO prices have peaked. It's about 4,200 at the moment. And we actually, my colleague, Adrian, who covers the sector, he's of the view that prices have peaked. In fact, it's peaked around about now. He's looking at prices to fall to 3,000 per ton. That's a steep fall. And we observed that in the past, right, during peaking CPO price, it's consistent because it always happens at the end. It's either the first quarter or second quarter. So we think that this year is no different. It's going to come down. And the reason why we think prices will come down is because, the production will recover. In fact, for Peninsular Malaysia, we see that the production decline has reversed. And also for East Malaysia, we are starting to see the production going up. So inventories will go up going forward. So because inventories will go up, and the prices should come down now. Then you'll be asking the reason why keep it neutral? Why not sell? Why not underweight? Now the reason is because of this. We think that the market has priced in this downside potential, maybe towards 3,005, 3,003. It's possible. You know why? It's because valuations again, price to earnings ratio, right? For plantation sector, the KL plantation, is -1 standard deviation below mean, right? So it suggests to us it's trading below mean. Market is pricing in a pessimistic view on ASP prices. So if prices do fall, we don't think it's going to fall by much, right? And the other thing, interesting thing to observe about plantation is that on the way up, from 2005 to 3005, obviously, the plantation stocks went up along with prices, but beyond 3005, from 3005 to 4002, it was very muted. I think it was like prices went up from 3005 to 4002. It's been like the past 4 to 5 months, but you see that stock prices didn't follow up, and one of the reasons could be that um, plantation is a sector which is well invested by institutions traditionally, but uh, of late, right, by and large, more and more institutions are becoming very ESG sensitive, and so it just may be the case that institutions are now no longer paying the kind of premium or the kind of price they used to pay. There is a kind of like an ESG discount. And in terms of ESG event that was negative for our market last year, it was with regards to Sime Plantation. Remember, the US CBP had a withdrawal order over some labor issue, which I think Sime Plantation is not trying to deal with. So, actually Malaysia as a whole has a kind of like a negative image in terms of ESG management. It's shown itself in plantation. And also rubber gloves, for example. You've seen how Top Glove suffered the US CBP ban because of allegations of labor mismanagement and so forth. So yeah, I hope I answered your question. But if you need to buy plantation, right, I think what's cheap would be Hap Seng plant. Hap Seng plant, okay, the beauty of Hap Seng plant is that it's got maturing tree profiles, right? We expect output growth to be quite strong this year and next year. So at least that will sort of like offset any price weakness. You still get your EPS growth for Hap Seng plant. Or if you want an integrated player, the cheaper one would be KLK. Yeah.
Okay. Thank you so much for the trade ideas. So since now that the glove is seems to be making some recovery, and then we have a few questions here on gloves. So Wong would like to ask, like, among all the glove counters, which one you prefer?
Okay, good question. I was half expecting that there'll be a question on gloves. So let me show you an interesting table. Yeah. Okay, this is the one. Your question was what again? Which would I buy? Is it?
Yeah, which counter would you recommend?
Okay, right. Here I show. I hope you can see the 4 key glove stocks: Top Glove, Harta Lega, Supermax, and Kosan. Okay, this is yesterday's closing price, and this is target price of each of those 4 counters. The highest upside is Harta Lega. We are looking at target price of 17 ringgit. Harta Lega is around about 11 ringgit now, 52% upside. Top Glove, we are looking at 15% upside. We have a target price of 680 for Top Glove. Supermax, we are looking at 780 target price, 24% upside. And Kosan 6 ringgit, which is 27% upside. Now, these target prices, we are confident of those levels. You know why? Because if you look at okay, calendar year. Look at the second last row here. Calendar year EPS. Say for example, Top Glove, right? We're looking at calendar year EPS of 52 cents per share, and using 680 as our target price. You're setting the target price at PE of only 13 times, right? And for at 17 ringgit, Harta Lega is trading at the target PE of only 17 times. It used to be 20 over times, even before COVID, right? And Supermax, target PE 12 times, 12 times also for Kosan. So these are based on target prices. In terms of current prices, where these stocks are trading at is much lower. I think for Top Glove, you're talking about, you can buy Top Glove today at 11 times PE, uh, next year's PE. Yeah. So yeah, I think for gloves, right, there is a concern over declining ASP in uh, FY22 next year. What we've done is that we penciled in $40 per thousand pieces, right? Today, this year, we are talking about something closer to $90. So we're actually more than halving our assumptions of ASP next year. And this is how we arrive at these numbers here. Okay, so unless we can be certain that ASPs will fall much lower than 40, I think gloves is a buy. And like I say, the pandemic is in a very milder form, but people, even after you get vaccinated, right? As I say, vaccinated individuals are not guaranteed from not getting infection. You still be infected, but it's, 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 it's an infection that is not a sort of a very severe case. But with that kind of expectations, right, you still be very, very guarded in terms of how you know, protect yourself against infections in the future. So gloves will continue to be used. The other concern on gloves would be China, right? There is a thought that there's this company called Inco, INTCO, China's largest rubber glove manufacturer, and they are going to list their 8 shares in Hong Kong soon. And I had a chance to look at the prospectus just recently. I think there was concern amongst investors that this Inco and other Chinese players is going to flood the market with a lot of gloves over the next few years. And I think that's very misplaced, that fear. For example, Inco, right, they're looking at about, over the next 5 years, they want to bring online production capacity of 200 billion gloves per year in 5 years' time. That's by 2025. 200 billion is 4 times Harta Lega. That's huge. Well, for me, I think that's a bit stretch of the imagination. But even if they can do that, right, 4 Harta Legas in 5 years, but I think that we can find comfort in the fact that this expansion is not going to be over the next year or so. In fact, in 21, they are expanding by 14 billion. In 22, it's only 5 billion. So they're only bringing in 19 billion capacity online. The 180 billion or so is probably towards the later half of the 5-year period. So let's see whether it will materialize. But what I'm saying is that if you're thinking about investing gloves this year and next year, you don't worry about the Inco, because the capacity expansion, even if they can achieve what they say they're going to set out to do, it's going to be the later part of maybe 2024 or 2025. Yeah. So I think I think I said enough about gloves. I'm still a believer in gloves. I think it's a value play, and we stand by our target prices here.
Thank you so much, Mr. Cole.
Yeah.
I also see that there are several questions on Silterra. So, looking at the worldwide chip shortage situation, so what is your view on the DNEX and also the Silterra?
Oh, I think I will not comment on DNEX. It's not a company that I know enough of.
Okay.
But yeah, there has been an underinvestment in chip facilities, fabricators over the last few years, and actually, this chip shortage is a result of maybe lack of investments in these facilities in the past because of the slow growth. But COVID has caused, like I say earlier on, consumption behavior that has accelerated the demand for chips. For example, work from home trend has created demand for more laptops, smart devices, apparently even gaming console, I'm told, like your Nintendo, uh, demand has suddenly shot up the roof, which is why PIE is having good time now. People work from home and they play more games, and then also because of more web computing, you're having more conference calls online, um, you know, uh, and that sort of thing creates demand for cloud computing and also data centers facilities. So demand for power management chips and so forth also go up. So uh, it reflects the kind of like strong demand for chips, electronics. Not forgetting also the demand from the recovery in auto sales globally, and also we're seeing more electrical vehicles being manufactured. So I think there is a structural, quite a long-term upside for technology. Yeah. So if you like technology, you can buy Inari. We like DNO. They supply um, LEDs and semiconductors for cars in Europe, in US, globally, in fact, in China as well.
Okay, thank you so much, Mr. Cole. Um, Now, just now you were quite bullish on banking sector. So the question by Jeremy is that for banks and financial institutions, will there be any significant impact on the bottom line arising from the deferment of loan servicing and through loan scheduling from a higher incidences of default and foreclosure?
Okay. Yeah, I think last year was a year when the banks were marked by the provision of loan moratorium. And the bank suffered what we call a day one modification loss. I think that's largely behind us. The latest numbers we got from talking to the banks has been that the uh, those loans that are still under assistance programs, right, have come down to between 10 to 15%, depending on which bank you talk to. They used to be much higher. And also, I think if there's any more modification losses going forward, it'll be much less because, yeah, I mean, the loan are being restructured in a way that, will be less negative on the banks. I think the banks are trying to strike a compromise between them as lenders and also the borrowers who are in trouble. So we don't think there's going to be much more damage. Yeah, I mean, banks will be more lenient and they may not recognize uh, these assisted loans to be uh, sort of non-performing. I don't think they should. Um, yeah, we don't think it's going to be a big impact. And like I say, the economy is expected to recover 6.5%, and with the economy recovering, then the risk of you know the risk of defaults and stuff will be much reduced, lah. So one of the reasons why we like banks is because we think credit cost is going to normalize. Uh, Not normalize, I think that's the wrong word to use. Credit cost is probably going to come down because in 2020 there's been a lot of provisions, especially towards in the 4Q. Um, there's a lot of preemptive front loading, the overlays they call. So a lot of them there's a buffer there already. So I think going forward to this year, I think the chances are, they don't have to provide as much. Yeah. If you like
Okay.
banks, we would recommend Maybank because Maybank has good dividend paying capacity. They've got a track record of paying good dividends, and or RHB because they've got very strong CET1 reserves, so they have more leeway to manage dividends and that sort of thing. Yeah, safe as well. Safer.
Okay, thanks for the trading idea. Um, the next question is on oil and gas. Like Tom would like to ask, like Mr. Cole, since the economy is recovering, what is your view on oil and gas sector?
Oil and gas structurally not so favorable. You know why? Because the world is turning against fossil fuel. I think even like in the car industries, right? government policies are discouraging fossil, traditional, combustion engine cars. They are encouraging usage of EVs, for example. So yeah, that's definitely negative for oil. The other thing also is because I think supply side, OPEC isn't what they used to be. I mean, OPEC was very powerful. They were able to control prices, but I think they're losing that grip now. I think I was told that if, say, Brent goes up to 75 or 80, right, you see the US shale, coming, turning the tap on, and then, that will spoil the upside. So I think there's very limited upside to oil price lah going forward. And then there's also the ESG concerns. Nowadays, more and more oil and gas majors are investing more of their money into renewables rather than fossil fuels. So generally, we're not really keen on oil and gas.
Okay,
No, yeah.
understand. The next question is by a very observant attendee. He asked that, in your previous recommendation of KGB and Kerjaya, these two are one of your picks last time. So, but I don't see them in your latest list here. Are they still worth holding? So this is the question by this attendee.
Right. I think I will get my analyst to talk to you. You can leave your name and your phone number. Call Shane. Yeah, if you're a customer of Kenanga, call Kenanga. I'm happy to get Sam and Joe to talk to you. They cover Kajaya, so they can give you a lot of details. You sound like a very knowledgeable questioner, and if you're so observant down to the details. So let me ask. I'll ask them to call you. Just give me a number. But KGB, as I say, KGB is what was the question? Is what's the call? Is it on KGB now?
Yeah, KGB.
Ellington Group. We still like it. We still have a outperform on KGB because they are one of those service providers that will. KGB, we have 260 target price. Yeah, it's one of those service providers that will continue to service the chip manufacturers. I told you earlier on, right, on the question of Sotera, there's a shortage of chips, and the manufacturers are going full capacity, and they are even expanding the production facilities to manufacture more chips. And KGB will continue to ride on that upside because they supply, the air purifying supply for these front end manufacturers. So they've gotten supply contracts with the likes of SMIC, and apparently SMIC is going to expand further this year and next year. So demand for their gas will also go up commensurately. Yeah. Kerja prospect, yeah, I'll get Joe to call you.
Okay. Lily would like to ask, how do you see steel and aluminum sector? Will this uptrend of commodity price last another 1 to 2 years from now?
Steel, I think long bars have had a good run. But I think long bars may come off. I think it might be peaking. The reason why I say that is because one of the reasons why long bars went up in the first place was because when China was, I think China was one of the first to have emerged from the COVID issue, the pandemic, and they basically the economy reopened and demand for long bars started going up. That's why they were replenishing inventories. So long bars shot up, and a lot of the producers, right, were inactive during much of 2020. So they're only starting to ramp up production. So I think when the production side catches up, right, you're going to see supply coming in. And so that's when you're going to see long bars start to weaken. If you want to buy, if you want to pay steel, we prefer flat steel. The stuff that, like for example, CSC would do. The cold roll coil, you shape them into sort of plates for electrical devices like refrigerators and so forth. That kind of product. I think the prices are holding better, and because flat steel and long steel, they actually consume the same raw material, iron ore, scrap metal. Um, because of better pricing for flat steel, the flat steel players will be able to buy up more of this ore and being less sensitive to cost compared to the long steel buyers. So I think the long steel producers' margins might be squeezed because if your raw mat price goes up and then you have very little pricing power for the long steel bars, then your margins will come down. Whereas the flat steel people can pass on higher raw mat costs down the line. So if you want to buy steel, we prefer CSC steel or maybe even Ulicorp. Ulicorp is also doing flat steel. So, yeah.
Okay, thanks for the idea. There's one question from YouTube who would like to ask, he says Jeff would like to ask, like, how should investors approach the market if the national emergency status is uplifted or a general election is called? Should we reduce position or should we buy on deep?
Wow. Okay. It's a pretty tough call because to try and time entry exits based on election timing is extremely tricky. I'm not sure whether anyone can reliably do so. I'm not sure even the Prime Minister himself knows when to call the election to start with. You have to be really long term about investing. I think if one is fearful of election, then avoid political sensitive stocks. I mean, you can buy technology. This market is mainly abroad. It doesn't matter what happens in Malaysia. Um, so or even plantation, for example. It's politically not sensitive. Um, Maybe you want to avoid a bit of construction, if you're fearful. But yeah, what I'm trying to say is that do invest for the long term. Do not let the risk of elections, derail you from being very how do you say, certain about what you want to do with the investments. If you are fearful of elections, avoid election political sensitive stocks. At the end of the day, you want to be comfortable in your own decisions, right? You'll sleep well at night, I think. But anyway, if I had to answer questions in elections, I would say that well, what's the outcome? We've got Perikatan or Pakatan, Harapan, Anwar and friends, or maybe more of Muhyiddin. Both parties, both sides of the house, we've seen them in government before. It's not parties we don't know. So in a way, that's kind of a relief. It's two parties we know who have been in power before. And right now, if not for the emergency, we'll be very tense up because it's a hung parliament, isn't it? I mean, it's a very thin majority. So one hopes that the election, when it's held, would really resolve this issue of very, a majority that's just too slim to be comfortable about. So chances are, I would bet that after elections, maybe we can have we'll have a government that's more stable. So that's good for the market. Yeah.
All right, thank you so much, Mr. Koh, for the question and answer session. So let me tell you more about our next sessions. So let me just share my screen. All right. So our next session for CanTrade webinar is making friends with trends. So it is happening on next Thursday, which is 6 May 2021. So I've just given you the registration link in the chat box and also in the YouTube live chat. So please register for this session if you want to know how to do trend following. As you know, big bucks are made on trends, and strong trend means help you to make strong return, and then weak trend help you to make weak return. So in this case, right, making friends with trends, we are going to explore and delve deeper into the trend following strategy. So if you want to learn trend following strategy, do register for this making friends with trends session happening next Thursday. So after this making friends with trends sessions on the 11th May, we have this session with live chat with Tongguan Industries Berhad, innovation for sustainable efficiency. Just now in Q&A, right, I see that there are people who ask about Tongguan. Now, if you want to learn more about Tongguan Industries Berhad, please reserve your calendar. 11 May is the Tuesday. We will be hosting the Executive Director of Tongguan Industries, Mr. Alvin Ang, to come to our CanTrade webinar, so he can share with you Tongguan company's background, the business performance, as well as the future plan ahead. So for those of you who have not had a Kenanga trading account, so please fill up this online form, www.cantrade.com.my/open-account-form to put in your interest. So when you put in your interest to open an account, then Kenanga will arrange a friendly dealer representative to attend to your request for an account opening. So with that, I want to thank all of you for tuning in to this CanTrade webinar. We also want to thank our honorary speaker, Mr. Koh, the head of research from Kenanga Investment Bank, for sharing with us your research insights so that we know how to plan our investing strategy ahead and what sectors should we put our attention on. I think just now you have given us many great ideas about what sectors and what stocks to look into, and we really appreciate your input. Thank you so much, Mr. Koh.
I hope it's helpful. Thanks.
Yeah, look forward to hosting you again in our next CanTrade webinar.
Okay, thank you. Bye-bye.
All right. Bye, everybody. Have a great, pleasant rest of the day. And remember to stay safe, protect yourself in this pandemic.